can access data from many sources. And we are introducing new data feeds fairly soon. eSignal is something that's going to be happening fairly soon. All right, I've loaded the data that I downloaded from Yahoo Finance, and the first thing I like to do when I load the data is I simply click on the Analyze button, which is what I did here, and this is the default analysis, if you like. Let me actually just quickly pop up some information on this chart, which I find useful, what we call the Hurst cycle synopsis information, and I need to also tell it to show information on the chart, because I turn that off. Show chart, there we go, and there we go. So you can see I've called this particular chart default, and it's a daily chart. It's an end of day chart. Right. So I just clicked on the Analyze button, and Sentient Trader did its thing, and it's produced its analysis. Now I am taking the approach in today's Trader Chat and in all Trader Chats that you all have some understanding of Hurst cyclic principles, and I think that is true. If it's not, then raise your hand and ask some questions. I'll be very happy to explain things in more detail. But I'm going to sort of I'm going to assume that you have some understanding of Hurst cyclic principles, and so you understand that Hurst cyclic principles tell us that the price movements of financial markets are the result of multiple cycles that are moving all at the same time. And those cycles are synchronized at their troughs. In other words, their troughs are synchronized, not their peaks, and that the cycle troughs are presented on a chart by means of these diamonds that are plotted at the foot of the chart. And you can also in Sentient Trader display semicircles, which I've done, which makes it easier to visualize the cycles that are playing out in the market. All right, so this analysis is the default analysis. I haven't touched anything in Sentient Trader. This is what it does, and most of you will probably be very familiar with this analysis. Let's take a look at a few of the sort of highlights of this analysis, if you like. Let's see what might be going on in the Australian market. Before we get too deep into the discussion, I'm going to tell you I don't think the default analysis is perfectly correct in this particular market, and I'm going to be explaining to you why I don't think it's perfectly correct, and I'm going to show you some alternatives that I actually think are playing out. Okay, the first thing to look at, and whenever I look at a new analysis, I always start at the longest cycle. So the longest cycle here is the 4.5-year cycle, which according to this analysis, you can see at the bottom right of the chart, Sentient Trader reckons is currently running at about 50 months, just over 50 months in length. So not 4.5 years, but 4 years and about 2 months. Okay, and so now the first thing to notice is that, of course, in March of 2003, we have a trough of that 4.5-year cycle. Now that's a very common analysis that comes up with pretty much any market that you analyze around the world. When I analyze South African markets, the trough is in March of 2003. If you analyze most US markets, the trough is either in March of 2003 or in late 2002. Why do I mention other analyses when we're talking about the Australian market? I mention other analyses because it's very important whenever you're considering an analysis that you understand that markets around the world tend to move with what's called commonality. In other words, they all tend to move not perfectly in sync, but they beat out a similar rhythm. It's almost as if though the cycles that are affecting the markets around the world are a whole lot of drummers that are beating according to the same rhythm, and the emphasis points might be at slightly different times, but the general movements tend to occur together. Okay, so that's a perfectly reasonable position for the 4.5-year cycle. However, what it does then is it then positions the next 4.5-year cycle here in August of 2007. okay, which for many years people have considered to be very reasonable, and we've spoken about it as a famous, what is called a straddled trough. Okay, a straddled trough is a trough that is more prominent than the troughs to each side of it. So you can see the shape here. Like that, and the straddled trough is this trough over here. Okay, so so that's the second trough. Let me just clear the whiteboard, and there we go. Right. So we've got a 54-month cycle trough over here, another one here in August of 2007. And what's happened since then? Well, according to this analysis, the first 18-month cycle trough occurred here in March of 2009. The next one occurred over here in, I think that's May of 2010. And then the third one occurred in July of 2011, according to this analysis. I keep saying according to this analysis because it's very important that when you're looking at analysis, you understand that the analysis has been done for you automatically. One of the, it seems like an odd thing for me to say, but one of the dangers of working with Sentient Trader is that you get seduced into just accepting everything Sentient Trader tells you, okay, which means you stop thinking for yourself. And I consider that a danger, because as soon as you stop thinking for yourself, you stop being critical and you stop really thinking about things, and some things can sort of pass unnoticed, and it's very important that they don't. Okay, so what is my first opinion of this analysis? Well, because there are three 18-month cycles since the August 2007 cycle trough, that means that the trough in July of 2011 over here has been given a 4.5-year cycle prominence. Now, that doesn't sit very comfortably with me, and I think you will agree that it just looks a little bit odd. You don't have to be a cycles expert to know that a really prominent cycle trough like the 4.5-year cycle trough should look prominent, right? Okay, it seems like an obvious thing to say, but a prominent cycle trough should look prominent, and obviously the trough in 2003 does look prominent, so that looks fantastic. The trough in 2007 doesn't look that prominent, but that's explained by the theory of a straddled trough. So occasionally you'll have a straddled trough. But now we have another trough in August of 2011, and that doesn't look very prominent to me. So that's my first immediate problem with this analysis. I would question it. Okay, and I'm going to show you how we can explore some ideas around that in a moment. What other problems do I have with this analysis? Well, let me zoom in, and I'll show you a very big problem that I have with the analysis, which is the positioning of the trough in August of 2011. Is it August? Yes, it's August of 2011. Okay, let me change the display of the chart to a daily chart. Okay, that's a daily chart. We were looking at the weekly chart there. Okay, generally when you're looking at the bigger picture, it's much easier to look at a weekly chart. But let's have a look at the daily chart, and you will see that that the really prominent trough has been positioned by Sentient Trader here in August of 2011. All right. Now, obviously that looks sensible, and you will understand, and again, I'm assuming that you have some experience of analyzing markets using Hurst cyclic principles. You will know that Hurst's an analytical process involves looking at the chart and using what's basically a pattern recognition process to identify really prominent troughs. So yes, that would be that does jump out as a really prominent trough. However, there's something that really worries me about that trough, and that is that trough is formed by one single day's price movement. Let's zoom in there and have a look at it. Okay. Now, I don't know what was happening in Australia on the, what date is that? On Tuesday, the 9th of August, 2011. But if you have a look at that one single bar, okay, then you will see that price had been falling, of course, okay. After the weekend, price continued to fall on the Monday. On the Tuesday, it looks as if though the whole of Australia panicked, okay, and the stock market went down to a low point, which is this low point over here, okay. But then during the course of the day, they realized, okay, hang on, I don't need to panic, and the stock market bounced up again. All right. It's very useful to, when you're looking at a chart, to be able to read the candles. These are candlestick bars, and of course, a green candlestick bar indicates that the market closed at a level that was higher than the level at which it opened. Okay, and then the thin, what are called the shadows, or the thin sort of grey bits of the bars, extend down to the low price of the day and up to the high price of the day. So you can see that what happened during this day on August the 9th of 2011, price opened at this level, okay, fell down to a level right down there. Oh no, I beg your pardon. I've drawn that wrong. Let me try that again. It opened at the open level, which was over there. So it opened over there. It came down to that level over there. Then it bounced up to the high of the day, and then it closed over there. So very, very roughly from that single candlestick that I'm looking at there for August the 9th, 2011, you have an idea of what happened for the trading of that single day. Now, according to this analysis, Sentient Trader has positioned a trough at the moment of 54 months magnitude. In other words, a really major trough. It's positioned it on that day, and so that trough is a sort of a spike that happened on that day. Now, Hurst spoke about something that he called fundamental interaction. He said that often you will see the interaction of fundamental events, such as perhaps there was a news item on the 9th of August 2011, which caused tremendous volatility in the market. Fundamental interaction causes tremendous volatility, which is that, sudden panic and the market moves really strongly and then it moves all the way back again. Fundamental interaction is something that lasts for anything from a few hours up to a few days, perhaps a week at the most. Fundamental interaction is something that is caused by news events, causing us humans to react emotionally, because of course we are very emotional, and so we react emotionally, we panic, or we suddenly get very optimistic, and we do the wrong thing. Okay, we buy when we shouldn't be buying, and we sell when we shouldn't be selling, and the market behaves in an unusual manner.